as we talk about the broadening, I want to bring in somebody who wasn't necessarily a big believer in that story as it was happening, and suggested that he still wasn't the last time we spoke. Excuse me. It's our halftime headliners, Rick Rieder. He's BlackRock CIO of Global Fixed Income, joins us now on the phone for a conversation. It's good to talk to you. So we start our show talking about believing in the broadening, which you told me the last time we visited that you didn't really believe in it. Do you now?
So I would say a couple of things. So I think the show before I was on, the last one, we talked about could the equity market get you another 10 to 15% for this year, and I thought it was possible. You've gotten a decent amount of the move. By the way, I still think equities are going to do their job. But, I have to say, I was listening to some of the names. I like a lot of the names y'all were talking about. But you look at the valuations, I mean, you've got to continue to see the type of earnings growth. You've got to see top-line revenue growth with an economy that's moderating. And I just think there's a lot of good news that's priced in. And, it was for years, it was, there is no alternative. There is now. I mean, now you can get yield and you can get income at 6.5%, 7%, in the right places. So I don't know. I mean, looking at the PE, the equity market, the S&P at 24.7 off of trailing. And so if you say, gosh, I'm going to get 10%, I'm going to get 15% earnings growth. I think there's a lot priced in. I think it's okay. I think the golden age of watching, this incredible tech sector promote top-line revenue growth and earnings growth and free cash flow growth, I think we're done with that. I think, by the way, I think there's still good numbers, but I just think, gosh, you priced in an awful lot at this point. And it's okay. It's just okay, though.
You just think there's better risk-reward outside of equities with stocks at current valuations?
100%. By the way, we talked about on the show last time, the volatility market has dropped down again, that you can actually get long through calls. So we've actually, ironically gotten longer through because convexity, because the volatility is so cheap. Call options take you longer. With volatility so low, you can own the equity market and then have some insulation of the downside, and then, quite frankly, build income in other parts of the portfolio through some of the yielding assets and fixed income. So I think it's okay. I use a lot of volatility to get upside, and we've done that. We talked about we've sold some and rotated into where you get some real convexity using call spreads and calls outright.
So the Fed chair pretty much set the table for September. He may even have served up a tasty bite for investors. Ed Yardeni told me yesterday he doesn't think the Fed needs to do anything. All right, they can go in September, but they don't really have to do much because the economy's good. Former Dallas Fed President Kaplan told me as well in the last couple of days that he thinks the Fed's got time on its side, that they can still be data dependent based on the reports that are coming up ahead. Do you agree with those assessments?
I don't. I think when you take the price, if you look at where inflation is running, and you use all the metrics, you do 3 months, 6 months, you're running core CPI, you're running under 2%, you're running 1.6 on a 3 month. You actually strip out shelter because we know shelter comes down with a lag. You're actually running it pretty close to 0, and core PCE is getting down to 2. You got a funds rate of 5 3/8. If you got the funds rate to 4, you're still restrictive. And I think what people, and you see this in all the earnings reports, the people that are getting hurt, and the reason why you're seeing trade down at retailers, you're seeing low income having a tough time. The people that borrow, and much of the economy doesn't borrow today, the ones that do, low income, small business, local banks, are really struggling. And there's no reason for that to be the case. And so my view being, yes, get the rate down. You're not talking about go through an easing cycle. You're going to a less restrictive cycle, and just get the funds rate to that it's priced reasonable relative to where inflation and growth is. If you flew in from the moon and said what should be the right funds rate off of the current ecosystem conditions, you wouldn't say it's 5 3/8. And so I think the Fed chair is quite right in saying the time has come. In fact, I think the time already came. And I think you do it. I think some of the comments on financials, you look at charge-offs are picking up, delinquencies are picking up. By the way, for some of the big banks, it's not really a crisis at all. But for local banks, it does become an issue and a risk. So I just think you move the price to the right level and then evaluate where you are from there.
Would you go 50 in September to kick things off and make a statement?
I would have gone 50 in July. Yes, I would. But I've learned, Scott, over my career that it's better to invest based on what you think they will do versus what you would do. And I think I think they are going to be deliberate and look at the data. And I think the comments earlier, I think they'll go 25 in SEP. I think they'll do another 25 at the next meeting and another 25. Markets, part of, the equity market, enthusiasm around the Fed cutting. By the way, we've priced in, the market's now pricing in 4 cuts for 24 and 9 cuts through next year, getting the funds rate down to 3. So the rate market is certainly anticipating at least a 50 in there and going 100 basis points for the balance of this year. So the market's already priced it in.
Yeah, no doubt. A lot of stuff's priced in. Rick, I'm going to let you run. I appreciate you so much joining us on the phone. I know you had a hard out for us, and we'll talk to you again soon for sure. That's Rick Rieder, BlackRock, joining us for a special little visit there, which we appreciate. So.